Hello and welcome to the Mutual Fund Show. I'm Yogesh, and over the next 20 minutes, we'll talk about 2 or 3 key aspects surrounding mutual funds, aspects that some of you have written to us about, and aspects that we think are important to include in today's episode. To talk about these 3 things that we want to discuss today over the next 20 minutes, we have with us, and so that I don't get the company names wrong, Nisreen Mamaji, founder of MoneyWorks FS, and Yogesh Kalwani, head investments and family office at InCred. Both of you, thank you so much for taking the time out. I hope all is well. And Nisreen, you of course come before on the show, so good having you again. And Yogesh, since we are doing the show for the first time, great having you for the first time.
Thank you for having me.
The pleasure is ours.
So much. Pleasure is totally mine. Thank you, Neeraj.
Great, thanks. So let's start off with the first thing. There was a chart that I tweeted about 4 days ago, which showed that despite the small U-turn that yields generally have taken, value funds and value stocks are outperforming growth stocks thus far in 2022. So there is a distinct tilt on the global scale towards value as opposed to growth. Now, there are obviously funds and fund houses which try to distinguish or present themselves as ones that focus largely on quality at any price, or quality at reasonable price, or value as the case may be. And I'm guessing some funds have that distinct flavor. My question to you is, does it make sense from an Indian context, from an Indian mutual fund investor's perspective, to look at funds which might be doing so? Why or why not? Nisreen, will start off with you.
So let me take a minute to explain, what is the difference between growth and value actually, just to start at the beginning. So basically a growth stock would be a momentum stock, which you have bought at 100, say, for example, but you expect it to go to 200. Okay, so this could happen basically because of the, your company doing well because of market reasons, and also because there's an expectation the market sentiment has valued this company, at a higher rate later on. So that's why it's called a momentum. So, you're expecting the PE to be in your favor. A value stock in, vis-a-vis that is something that you buy, say, at 50 rupees, but its intrinsic value is 100. So it is out of favor right now, and that's the basic style of investing. So typically, when the markets are greedy, growth stocks are in favor. But when people are fearful, when the investors are fearful, at that point of time, the value investing will be more, in line with sentiment. Now, the reason why this happens, currently it's happening, is because of rising interest rates and inflation. So that is leading to a spike in bond yields. And the last 10 years has proved that there is a positive correlation between rising interest rates or rising bond yields and the performance of value stocks. So growth stocks will normally do well in a falling interest rate scenario,
Sure.
And value stocks will do better in a rising interest rate scenario. So right now, what has happened is till mid-2020, there was an influx of money. Trillions of dollars were put into the system, and that's why the growth stocks, the momentum stocks, took off. But right now, we are facing a time when this money is basically leaving the system, and that's why we feel it's a good opportunity to invest into value stocks. Now, the MSCI, India Value Index. So 54% of this index is comprised right now of Infosys, TCS, HLL, HUL, Maruti Suzuki, Tata Steel, Mahindra and Mahindra, HDFC, Bharati Airtel. So these are the kind of stocks which would be, considered as a value stock. Also, another point in favor is that the MSCI India Value Index is trading at a trailing PE ratio of 17.27 times compared to the 10-year average PE of 29 times. So that's another reason why, we feel that value investing is the flavor of the current time.
Okay. Now, before we get into maybe what kind of options do mutual fund investors have, Yogesh, can I get you in on this conversation? And what's your sense? And are there options available easily for an Indian investor to choose funds which might have that value style to themselves? And of course, predominantly, does it make sense for you for investors to look at value-oriented funds as opposed to growth-oriented funds?
Sure. So firstly, some more color on the growth and the value concept which Nisreen just shared. The way we look at the growth and the value contour is that growth it's a lot more about earnings also. So, and while value, you look at valuation parameters of P, PB, etc., compared to the historical paths, etc. Now the challenge where there is in India, if you look at like Nisreen just mentioned a few stocks, every investor will classify various stocks in a different manner. Some may look at it as a growth stock, some may look at it as a value stock. So the key point or the dilemma out here is the lens or the way you're evaluating a stock. You have to take some relative basis, either a historical or the stock's own past performance or relative peer group, etc. So it's very difficult to classify stocks specifically into growth or value. And the stocks also keep changing color from a value to growth depending on how well they have done in the recent past, etc. So the sense which we have is the style of a fund manager to adapt from a growth and a value parameter perspective. We haven't seen a distinct style emerge. So there is a blend. Fund managers do have stocks in the portfolio which are typically having a growth visibility and an earnings consistency, and they look at adding that in the portfolio. Certain stocks which they feel are reasonably valued and also hold a promise of a revival of growth or a potential re-rating is when what gets added. So you don't have a fund if you have to implement a pure value style, or you don't really have a specific fund which really plays out a pure value style. So we have seen a lot more blend in the mutual fund availability and the options available for investors. And to our mind, a growth strategy is a strategy which has really paid off in a long term, because the factors what investors look at is that anything which has a consistency in growth, visibility of earnings growth, that typically reflects in a stock market performance and hence a mutual fund return performance. What you're seeing challenges in a value side is there are value traps, wherein the company sometimes underperforms, and then you land up not delivering not even the results on the corporate earnings side, not even the returns. So our preference remains on the growth style. But the biggest dilemma for an investor is there's not too many purest value fund propositions on the street.
So I can just add on that is it's always a blend, because you can't have value without growth. So if you ask for a couple of recommendations of mutual funds, I think I would possibly recommend the ICICI Prudential Value Discovery, which is done well in the 3-year, 5-year, and in the 10-year segment. And also the UTI Value Fund, the Nippon Value, and the L&T Value, which is outperformed in the 10-year category and not so much in the 3 and the 5-year. So, I think these are the top, couple of recommendations I would be offering if you ask me for the value mutual funds with the blend of growth.
Sure, got your point. Okay, some people find value in growth, and I think Nisreen is trying to make the point that she's tilted towards maybe value getting an uptick, and there are some of the funds that she believes can combine value and growth, but largely fall on the value side. Now, Yogesh, therefore, my question to you is, if you are on the opposite end of the camp, are there therefore high growth funds that you reckon, or fund houses that chase growth stocks, but which might be good investments that you guys might be comfortable talking about?
Sure. So the way to look at it is growth at reasonable valuation. So that's itself is a concept called CARP. So growth at reasonable price. So if you look at fund managers, typically have a lot more balanced approach, whether the companies are growing, stocks are growing at a right, have a visibility and an earnings growth, and they're priced appropriately. They're not overpriced, they're reasonably priced, and hence they become a part of the portfolio. So two such funds which we like, one of them is SBI focused FLEXI cap fund. We feel they've done well, and it has a long track record, and it follows this philosophy in a great way. The second is UTI FLEXI cap fund. While there is some underperformance in the last 6 months period or 5 months period, but we feel that will overcome. That's largely due to a healthcare allocation which has not played off for them. But as a blend of a style and a growth at a reasonable price, both these funds tend to deliver returns over a longer period of times and across market cycles.
Interesting. Okay, thanks for that. Now, let's shift topics and move on to the second one. And Yogesh, can I start off with you on this one?
Sure.
And which is about passively managed ELSS schemes. And all through the last 4 years that we've done the mutual fund show, standard rule viewers, we've urged everybody to not think of ELSS schemes only in the months of Jan, Feb, and March in order to save tax. Even if you want to do it only for saving tax, start thinking about it from the month first itself. We've done 2 shows in the first 2 months. And now that there is a bit of a circular that has come out as well, we thought it's best to bring up this topic too. Now, because there is an option possibly very soon in a large way of passively managed ELSS schemes making a beeline into portfolios. Yogesh, what are your thoughts here?
So see, India, if you look at, I'll say it's 2 worlds on the passive and active side. If you look at market capitalization wise. So if I have to say, when it comes to, if I take a, say, last 5-year track record, calendar year wise track record of various capitalization breakup funds, say large cap, mid cap, small cap, the 3 different distinct categories. The large cap funds, if I look at last 5 year on an average, only 34% of them have outperformed their benchmark indices. So a lot more difficulty to beat the benchmark, very well researched, I would say the category has not too much differentiation, good companies perform better, etc. So out there, I would say 34% of the funds in the large cap category managed to outperform their indices. It looks attractive on the mid cap and the small cap side. That's where you see 54% of the funds, they've outperformed the indices over the last 5 years. And if I even take it on a year-on-year basis, calendar year basis, rather than a point-to-point basis, you've seen them outperform across market cycles. And that's where it reflects that India is a market which is a lot more bottoms-up market. The fund managers are able to identify ideas on the mid cap and the small cap sides much better. So the passive strategy on an ELSS, if an investor is looking for a pure large cap play, now coming to what ELSS as a category has, ELSS typically has a mix. If I take a broad industry level mix, it's 65% large cap and 35 between a mid and a small. So, and you have various funds. You have funds which are focused on mid and small. You have funds which are focused on a large cap side. So if an investor wants to be a little more conservative, then a passive strategy, which means a large cap oriented strategy, makes sense for him. But if he wants to look at mid cap and small cap, which is the best for a 3-year time horizon, which an ELSS has, then an active managed fund makes more sense.
Okay. So, yeah, sorry. Please finish your point.
Yeah, so that's a segment. Even the active fund managers have outperformed the benchmarks over the last multiple years.
Okay, clearly. So I guess viewers, what Yogesh is trying to say is that if you are a type of investor who wants to invest in a large cap ELSS scheme, if there is one like that, then maybe the passively managed ones might be a great option. But otherwise, a FLEXI cap or funds focused on mid caps and small caps in the ELSS category might be great bets as well. Nisreen, there is an ease, I presume, with which there will be an ushering in of some of these schemes as well. What's your sense? Are you in the same camp as Yogesh, or does your opinion differ?
Not entirely. See, basically, the caveat is that you can either have an active fund or a passive fund. So most of the existing fund houses already have active ELSS schemes running. So this opportunity is only for the newer fund houses maybe to introduce a scheme. Secondly, their allocation has to be from the top 250 market stocks. So that will basically be large and mid only, okay? Because it can only comprise the top 250 companies in terms of market cap. So the indices would be the Nifty 50, the Nifty Next 50, or the Nifty 100. So this would be it would be basically large and mid. Now the issue is that in the last 1 year, less than 40% of the active ELSS funds have outperformed the BSE 500 index, and in the 3 and the 5 year segment, it's less than 30%. So there is an opportunity, perhaps for the passive funds. One is obviously because of the lower costs. Say, for example, the Axis long-term equity, the expense ratio is 1.68, but for say a Nifty fund of Axis would be 0.4%. So there is a, if you want to consider, that you want to enter an ELSS fund and the cost is of issue to you, then definitely the passive funds have something, a role to play. And also because the active funds at this point haven't really outperformed the BSE, 500 total return index. So if you want to judge a fund even on that basis, then there is an opportunity for a passive ELSS fund at this point, I would think. And the category itself has delivered an average return of, say, 12% on a 3-year basis and 15% on a 10-year basis.
But Nisreen, could it be that some of the fund houses, I don't know the answer, I'm asking you. Could it be that some of the fund houses which are actually not focusing on the large caps as much as the broader end might actually have given better returns and might be a part of that 60% which has actually outperformed the corresponding benchmark?
Yeah, absolutely. That's very fair to say that that's absolutely possible. So it's a mix of both. Obviously, when you're paying for an active fund, the cost is going to be higher.
Sure.
So cost should not be the reason that you're selecting the fund in the first place. But for an investor who is looking at that, at least the choice is available.
Agree.
Let the choice be the investors, and but as I said earlier, most of the fund houses which have been running for a long time already have an active fund in place, so they will not have this opportunity of introducing a passive fund. So possibly the newer fund houses have this opportunity, and if they give it, at least we'll have a bigger array.
So so Nisreen, let me drill it down then. Therefore, would you believe that if as and when some of these new passive funds come in with very low expense ratios, they might be a fighting alternative to some of the existing large cap oriented ELSS schemes?
They can, but on the other hand, if they are newer, then it's very difficult for us to gauge even their processes, their fund managers. So on what basis can we recommend?
Okay, fair call.
There has to be a reason also. The 4 Ps have to be in place also. And if the new fund houses introducing this, then we don't have any historic figures to decide.
Sure.
Even if it's the same fund manager but having managed some other funds, there has to be some reason for us to recommend. So I would prefer to wait and watch, because if it's a new fund house and a new scheme, then it's not appearing anywhere.
Sure. Okay. Wait and watch, at least when these new funds do come in. Yogesh, just one question. You seem to be tilting towards funds in general, which might have a bit of a flavor at the mid cap and the small cap and in the ELSS category. Is that a correct thing? You would recommend people should try and look at some of those kind of funds on the ELSS category?
Yes, absolutely. See, the ELSS is a perfect time horizon for equity investments. So while you're doing it for tax reasons, ideally all equity fund investments should be 3-year plus. So 3-5 year plus. So this is where you have an ability to lock in, and you don't really look at this part of your portfolio for a very long period of time. And hence investing in a little more mid cap and active managed fund area will pay off is what we feel.
Okay. Now, for the final question, and which has now come up so many times, and Nisreen, I'll start this with you. It gained more credence when the last week that we did a show with CRISIL on their rankings. A bunch of funds which were ranked number 1 across equity category were from fund houses which are in the stages of nascency, so to say. The fund houses themselves are new or are small. The schemes don't have a very high AUM. And these are getting ranked higher, not just because of the returns that they're giving, because CRISIL has multiple parameters to that. And I see that happening in a bunch of other ratings and rankings as well. So Nisreen, my question is, I'm using these names just arbitrarily. I'm sure there are probably more, but a Quant, IDBI, PGM, which are all smaller houses. The schemes are smaller. Are these guys doing something right in order to get ranked higher, which is not just a reflection of the performance, by the way? Do you like any of these? Why or why not?
So yeah, actually we do, Neeraj, definitely. Now, for example, the PARIKH FLEXI cap scheme, the AUM of PARIKH itself is about 23,000 crores, but the FLEXI cap fund is about 21,000 crores, So in terms of the, PARIKH will probably come in the AUM, of the bottom end of the spectrum, if you're looking at just AUM, but it's done very well. The beta over 3-year, 5-year has been low. It's less than 1. but the alpha over the benchmark indices has been, for 3 years, it's been 8.21, for 5 years, it's been 6.47, and the 3-year performance has been 22.69 for PARIKH. So we have been including that in the FLEXI cap allocation. Another one that I like is the Mahindra Manulife Multi-Cap. It's called the Bandhan Yojana Fund. Now, here again, the AUM of the fund house is about 8,000 crores. And, of this fund is, of course, a smaller section of it. And here again, the 3-year performance is given about 20%. And it's following the, the multi-cap SEBI regulation to the tilt. And its performance is also really decent, I would say. So again, the beta has been less than 1 over the 3-year, 5-year segments, alpha over the benchmark. So I have been including that. Our team has been definitely recommending the Mahindra Manulife Bandhan Yojana Multi-Cap Fund. And another one that we like is the PGIM, India Mid-Cap Fund. The mid-cap over the 3-year, 5-year, 10-year plus categories in the performances has been outstanding. And, I follow the Morningstar, the advisor workstation to a large extent. So we look at the asset allocation, we look at the performances and, all the 4 Ps, and it's consistently topping the charts. So these are 3 of my favorites, and I thought I would share that with you.
Okay, just a quick follow-up on PARIKH. Now they have this hindrance of not being able to invest in the global side.
National fund,
is that a pickle, and would you therefore want to wait it out for a bit until the permissions get revised?
So for the SIPs, we can't, they are hitting the targets for the international sectors. But according to all the reports and information that we are receiving, this is probably going to last for another 2 to 3 months. So at this point, we would just wait and pause. The SIPs will continue once this, hindrance is lifted, and so we don't have to do anything actively in terms of pausing and restarting. I think we'll continue as planned, even if the international component is on pause right now.
No, sorry. So you're saying that you would still advise people to continue investing in PPFS, or should they take a pause and wait for the limits to get revised?
No, so it's an automatic pause as of now.
Okay, fine. Okay. No. But from an investor's perspective, the investor can still invest into the PPFS scheme, right?
We'll continue with the investing.
You will continue with the investing?
Yes, we will continue. That's
what I'm asking. Okay, fine. Perfect. Yogesh, the same question really. And would want to understand if you believe that some of these smaller houses, are they more nimble? Are they able to do something that the larger houses are not, or is it a function of the AUM? Do you like that aspect or no? And if you do like some of the smaller fund houses and the smaller teams, which are those and why?
Sure. So firstly, when a fund is a smaller size fund, the ability for them to they're a lot more agile on the portfolio, because they can move in and out of stocks opportunities with a lot more ease. So as the fund sizes increase, the AUM increases. That's when you see a lot more cautious approach by fund managers to exit the entire position, or because of impact costs, the liquidity in the market, various factors. So the best way to analyze the performance of fund is when you start looking at them, how they're doing after they reach some larger threshold sizes. So that's when your real performance really shows up, and that's an apples to apples comparison with the bigger, larger AUM funds which is there. So the challenges of a larger fund and a smaller fund are different, and hence you do see a lot more differences on the return side, and that can really amplify in a shorter periods of time when the markets are volatile. For a smaller fund, AUM to sit on a very large component of cash mid-month, quite easy. Now, our philosophy or take is I'll step back, I'll go a little macro, wherein the way we look at it is that for an investor to look at any equity fund house or an equity manager, they have to first look at the ability of a fund manager to attract talent, the AMC, the asset manager, to attract talent, build and invest in an equity team. So that's why what we look at is an overall assets managed at a fund level, which means, say, if I look at 40 plus fund houses which we have in India, how many of them are really 10,000 crores and above in equity assets, or 15,000 crores and above in equity assets? So those are the set of mutual fund managers or asset managers who are ability to invest in equity fund management team, investments, analysts, trading systems, compliance, regulations, etc., is far more higher than a smaller fund houses with a few thousand crores of assets. So our bias is towards, we have kept a cutoff, 15,000 crores and above. Any fund house which has assets, we like them, and there are still 20 plus fund houses. So you do feature a couple of names here, which are on the, I mean, I've just started above the threshold of 15,000 are growing rapidly. So the biggest one will be 1.5 to 2 lakh crores. So that's a difference. So the 20 fund houses which have 15,000 crores and above AUM in equity assets across is the focus area, because they can retain managed talent. And out there again, PARAG, PARIKH features in, so with 20 odd thousand crore of assets. So what Nisreen talked about, PARAG, PARIKH FLEXI Cap Fund is something, even that's our choice in a smaller fund houses relatively, and is growing rapidly, and also is investing in the equity side of the business. And the fund has done extremely well.
Okay, so you're just completely avoiding the smaller houses per se as things stand right now.
Yeah, the reason to add, I mean, just sum it up, is because the ability for them to attract quality fund managers, retain talent, etc., is a lot more difficult than the bigger or a fund house which has scaled up.
I would definitely second that, because we have Taurus and Navi, something, I forget the second half of the name, and this ITI. So those are the ones that I would be a little scared to recommend until the processes and the research and analyst team and even the sales and distribution team is in place, because that's the person that we need the most. The sales and distribution is the one that we depend on. So unless they have the entire team in place, especially the fund management, I would be wary as well. So I would definitely second Yogesh on that.
Fair call. Well, both of you, thank you so much for joining us today on the show with your intelligence and your inputs. I'm sure our viewers benefit tremendously by that. Much appreciate your time, Nisreen, as well as Yogesh.
Thank you. Thank you.
The pleasure was ours. And viewers, thanks for tuning into this leg of the Mutual Fund Show.